Thanks for joining us at xn.com. In this preview video, we'll be looking at the Nonfarm Payrolls report coming up on Friday. Fed Chair Powell said it loud and clear last week that the committee will be data-dependent moving forward, putting that much more importance on Friday's employment report. I'm Christina Marujos. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, expectations are for a pretty solid NFP report. What will that indicate about the U.S. economy, and how could it possibly shape market expectations about the Fed's policy in September?
Hello, Christina. So you are absolutely correct. The employment report is going to be very important for the Fed. In fact, Chairman Powell last week said that their decision about interest rates in September is going to depend on the next two employment and inflation reports. So a lot of emphasis on this upcoming data. Now, overall, the U.S. economy is doing really well, Christina, all things considered. So economic growth is running around 2%. Consumption has been really solid. The labor market is still in good shape. The unemployment rate is near a 5-decade low. And even the housing market is supposed to be the most interest rate sensitive sector of the economy. Even the housing market has staged an impressive recovery lately. So the U.S. economy is doing fine overall. It's probably the strongest major economy out there, at least compared to Europe and China. So the upcoming employment report is likely to reaffirm this strength. Non-farm payrolls are expected at 200,000. That's almost the same as last month when it came in at 209,000. The unemployment rate expected unchanged at 3.6%, and average hourly earnings are seen slowing down a little bit to 4.2% from 4.4% in the previous month. Now, looking at early employment indicators, they support the notion that it's going to be another solid report. Applications for unemployment benefits, those are initial jobless claims, fell during the month, which suggests that we didn't see any signs of mass layoffs among U.S. corporations. Business surveys revealed the slowest pace of employment growth since January, but that sounds worrisome, but it's been a fantastic year so far for jobs growth. So even the slowest pace of employment growth is still likely to be pretty solid. So the one area I would pay special attention to is wage growth, because those same business surveys reported rising salary pressures among corporations, and therefore there might be some upside risks surrounding the average hourly earnings print. So overall, if we get a pretty solid employment report, Christina, that could refuel some bets that the Fed's tightening cycle might not be over just yet, and that we could see another rate increase in September, perhaps.
Remains to be seen, but let's look at the market reaction as well. How could the dollar perform, Marios, on the NFP report this week?
Yeah, so I think the most important aspect is wages. And if we see an upside surprise there, that might be slightly positive for the dollar. Now, here's the entire picture for the dollar. As we already mentioned, the US economy is far superior to its major competitors at the moment. The US economy is doing fine, whereas if you look at Europe, business surveys suggest that the European economy is descending into a recession. In China, the economy has been kneecapped by the slump in global manufacturing. So even though the US economy is not amazing, it's the strongest of the major economies at this point. And that has not been reflected in the FX market so far. The dollar has been range bound and slightly weak for the entire year, even though the US economy is outperforming. Now, why is that? I think it has to do with central bank pricing. The markets still think that the Fed is likely to cut interest rates before the European Central Bank does next year. Which is strange considering that the European economy is already struggling. Now that, I think, leaves scope for some repricing in the bond market. If we continue seeing the US economy outperforming Europe, that's likely to be reflected in euro dollar in a negative manner moving forward. And the final leg of why the dollar has been so weak this year is the euphoric tone in the stock market. The dollar tends to act like a safe haven asset. Therefore, when you get a huge rally in the stock market, that diminishes some safe haven demand for the dollar. And that explains why the dollar has been so subdued this year. But it also means that if we see any correction in US stock markets, that might also be a factor that helps the dollar to get back on its feet.
Marios, thanks so much. This was a preview video here at xm.com.